All right, ready to dive in. Today, we're tackling financial management.
Specifically, we'll be looking at how companies make big decisions.
Yeah, those decisions around investments, financing, and of course, the thing everyone wants to know about, dividends.
And our roadmap for this deep dive.
Well, we've got some fascinating lecture notes.
From the ACCA Financial Management course.
Week 1 to be exact.
So think of this as our little sneak peek.
Behind the curtain of how companies make those big financial calls.
Exactly. By the end of this, you'll not only understand the key concepts,
But you'll also have some pretty cool insights.
the kind you can drop at your next meeting or dinner party,
So let's imagine, just for a second,
if you're suddenly in charge.
of a company's finances.
What would be your top priorities?
I guess I'd want to, make sure the company was doing well.
Of course, but what does doing well really mean in this context?
Well, the notes keep mentioning this phrase, maximizing shareholder wealth.
Right, that's a core objective in financial management.
But honestly, that phrase always makes me think of, like, Wall Street.
Cutthroat tactics, short-term gains, all that.
Yeah, exactly.
It's understandable to have that association.
So is that really all it's about? Just squeezing out as much profit as possible?
Not quite. It's definitely not just about short-term gains. Think about it this way. You want to build something that lasts.
Sustainable growth.
Exactly. Creating lasting value, not just a quick buck. Like, look at companies like Berkshire Hathaway,
They've been around forever.
and they've consistently focused on the long game.
Reinvesting profits, building for the future.
It's a very different approach compared to companies obsessed with hitting those quarterly targets,
Right, those companies that seem to prioritize the short term.
sometimes even at the expense of, well, their own future,
So it's more about finding that balance.
between short-term performance and long-term sustainability.
But honestly, in today's world, it feels like companies have to answer to more than just their shareholders.
Absolutely. It's not just about pleasing investors anymore.
There are employees, customers, the community, even the environment to consider.
It's a much broader landscape.
So how does financial management navigate all those competing interests?
That's where the concept of stakeholders comes in.
Stakeholders.
Basically, anyone who has a vested interest in the company.
Okay, so we're talking about, like, employees,
Of course, they rely on the company for their livelihood.
customers who depend on the company's products or services.
Absolutely. And don't forget suppliers. They're a crucial part of the chain,
And then you've got the community and the environment.
all impacted by the company's operations.
It's like a whole ecosystem.
Exactly. And each stakeholder can have different, sometimes even conflicting interests.
Okay, so it's not just about keeping the shareholders happy anymore.
Right. It's about understanding and balancing the needs of a diverse group.
Wow, that sounds like a tough job for financial managers.
It definitely adds complexity. They have to
Yeah.
consider the impact of their decisions.
On all these different groups.
Exactly. It's not just about crunching numbers anymore.
So let's talk about the more practical side of things.
How companies keep the lights on, so to speak.
The notes really emphasize the importance of working capital,
Working capital.
but what exactly is it?
It's the fuel that keeps the engine running. It's about having enough cash to cover your short-term expenses.
So we're talking about, like, paying suppliers.
Yep. And things like salaries, rent, those day-to-day necessities.
So basically managing that flow of money in and out of the business.
Exactly. And within working capital, you've got some key components.
Like inventory.
That's a big one. Raw materials, unfinished goods, everything's sitting there waiting to be sold.
Right. And then there are receivables, the money customers owe the company.
Exactly. And managing these effectively is crucial.
And of course, you can't forget about cash.
The lifeblood of any business.
It's what keeps everything moving.
You need it to pay your bills, invest in new opportunities, and weather any unexpected storms.
The notes mention a really interesting example here.
Oh, you mean Amazon?
Yeah, they've apparently achieved something called a negative cash conversion cycle.
It's pretty remarkable.
I have to admit, I don't fully understand how that's even possible.
It's about efficiency.
So they're basically getting paid by customers before they even have to pay their suppliers.
In essence, yes. They turn over their inventory incredibly quickly.
That's a powerful advantage.
That's like having a constant source of interest-free loans.
But I imagine it takes a very specific set of circumstances to make that work.
Definitely. A sophisticated supply chain, a deep understanding of customer demand.
It sounds pretty challenging, especially for smaller companies.
It is. But it highlights the importance of optimizing working capital.
So we've got this balancing act between keeping enough working capital flowing
while also making sure it's not just sitting idle.
And we have to consider the needs of all these different stakeholders.
It's a lot to juggle.
What happens if companies don't get that balance right?
Well, there are risks on both sides.
Yeah.
You can have too much working capital, which leads to inefficiency.
Like missed investment opportunities.
Exactly. Or you can have too little.
And that's where things can get really dangerous.
It's called overtrading.
Overtrading.
Basically, trying to do too much with too little. You might have great sales, but if you can't manage your cash flow,
You could end up in trouble.
exactly, even profitable businesses can run into serious problems.
So it's like a tightrope walk.
Finding that sweet spot is crucial.
Okay, so with all these factors to consider, how do financial managers know if they're making the right calls?
That's where the tools of the trade come in. Things like ratio analysis.
Oh, those financial ratios. I always hear about them, but never quite understood what they really tell us.
They're actually pretty powerful. Think of them like a doctor using vital signs.
To get a sense of a patient's health.
Exactly.
Yeah.
Financial ratios help us assess a company's health and performance.
Okay, so we're talking about things like profitability ratios.
Yes, those tell us how effectively a company is generating profit.
And liquidity ratios.
Those focus on a company's ability to meet its short-term obligations.
So like paying their bills on time.
Exactly. And then you have debt and gearing ratios, which look at a company's debt levels.
And of course, those shareholder investment ratios that investors love to talk about.
They give insights into a company's attractiveness from an investor's perspective.
So financial managers need to be fluent in the language of ratios.
They're essential for diagnosing problems, tracking progress, and making strategic decisions.
It's fascinating how these financial concepts, which can seem so abstract, actually impact every part of a business.
They really do. From the day-to-day operations to long-term strategy, it's all connected.
And that's where we're diving deep into this world.
To unravel the complexities and understand how it all works.
Exactly. So let's keep exploring.
There's much more to uncover.
More insights to gain, more tools to discover.
And more real-world examples to bring it all to life.
So buckle up and get ready for the next stage of our deep dive.
We're just getting started.
Welcome back. We've been talking about working capital and, making sure companies have enough of it to keep things running.
Right, that constant flow.
But now I want to focus in on two specific pieces: accounts payable and receivable.
Yes. Getting into the nitty-gritty.
They seem pretty crucial
Absolutely. Accounts payable and receivable are like two sides of the same coin.
when it comes to a company's cash flow.
Exactly. One side is about how efficiently a company pays its suppliers.
That's accounts payable.
Right. And the other side focuses on how effectively a company collects payments from its customers.
So that's accounts receivable.
You got it.
Let's start with accounts payable. I've heard some people say that it can be a smart move to delay payments to suppliers as long as possible.
To free up cash.
Yeah, it's almost like getting an interest-free loan, right?
Well, there's a bit of truth to that, but it's not always that simple.
How so?
Well, think about it from the supplier's perspective. If a company consistently delays payments,
It wouldn't exactly build a strong relationship.
exactly, suppliers are crucial partners.
And if you damage those relationships,
It can have long-term consequences.
so it's not just about squeezing out extra time.
Right, there's a bigger picture to consider.
What about those early payment discounts? I see those on invoices sometimes.
Yes, those can be a valuable tool.
How do they work exactly?
Basically, it's a way for suppliers to incentivize customers to pay quickly.
So the supplier gets their money faster.
And the customer gets a discount.
It's a win-win.
Exactly.
So if a company delays payment just to hold on to cash a bit longer
They might miss out on those discounts.
and actually end up losing money in the long run
Precisely. It's all about making strategic decisions.
and weighing those costs and benefits.
Now, beyond the strategy itself, how companies actually pay suppliers has changed a lot.
Oh yeah, with all the technology now.
Paper checks are becoming less common, especially for larger companies. Electronic payments are much more efficient.
So things like online banking transfers.
Yes, and automated clearinghouse payments, ACH transfers.
I've heard of those.
They streamline the whole process.
Fewer errors, faster processing.
It frees up staff to focus on other things.
Okay, let's switch gears now and talk about accounts receivable. This is about collecting money that's owed to the company, right?
Exactly. It's about managing that credit you extend to customers.
It's an essential part of business, but it also seems risky.
Definitely. There's always the risk of late payments.
Or even non-payments.
That's why clear credit policies are so important.
So you need to assess the creditworthiness of customers before extending credit.
Just like a bank would evaluate a loan applicant.
It makes sense. You don't want to take on unnecessary risk.
And once you've extended credit, efficient invoicing and collection procedures are key.
So sending invoices promptly
Yes, and clearly outlining payment terms.
and having a system in place to follow up on those overdue payments.
It can be a lot to manage.
I bet. The notes also mention that some companies offer discounts for early payment. Is that common?
It can be, especially in industries where cash flow is tight.
It's like the flip side of those early payment discounts for suppliers,
Right, you're incentivizing customers to pay faster.
which helps the company's cash flow
It's all about finding those little levers.
to optimize the flow of money.
Exactly.
So we've talked about credit policies and discounts, but are there other techniques for managing accounts receivable?
Oh, absolutely. One common technique is called aging analysis.
Aging analysis.
It's about categorizing receivables based on how long they've been outstanding.
So like which invoices are 30 days overdue, 60 days overdue, and so on.
Exactly. It helps identify potential problems.
And prioritize collection efforts.
Right. And then there are more specialized options like invoice discounting or factoring.
Those sound interesting.
They can be helpful if a company needs immediate cash.
How do they work?
Well, invoice discounting involves selling an invoice to a third-party financial institution.
At a discount, I imagine.
Yes. So the company gets cash right away.
But they don't receive the full value of the invoice.
Right. And then factoring is a bit more comprehensive.
In what way?
It involves selling your entire receivables ledger to a factoring company.
So they take over the whole collection process.
Exactly. It can be a good option for some businesses.
But I bet it comes with higher fees.
It does. It's important to weigh the pros and cons.
This has been a great look at accounts payable and receivable.
They might seem like routine processes, but they're so crucial.
They really are the heartbeat of a company's finances.
Well said. And there's even more to explore.
Oh,
Join us for the final part of our deep dive.
where we'll look at even more advanced techniques for managing working capital.
And we'll discuss how all of this applies to different types of organizations.
I'm ready. Let's dive in. Welcome back for our final deep dive into financial management. We've gone from those big picture goals to the nitty-gritty of managing accounts, those payable and receivable. But the notes mention some even more advanced techniques for managing working capital. What do they mean by that?
Well, it's about taking a more strategic approach. We've talked about the dangers of not having enough working capital, but believe it or not, there are also downsides to having too much.
Too much. Wait, how's that possible? I mean, if cash is king, isn't more always better?
Well, not necessarily. It all comes down to opportunity cost. Think about a company sitting on a huge pile of cash, way more than they need for their day-to-day operations. What could they be doing with that money?
Investing it.
Exactly. They could be funding growth initiatives, pouring money into research and development, maybe even making strategic acquisitions, things that could generate significant returns down the line.
So instead of just letting it sit there, they could use it to fuel future growth.
Precisely. Or they could even return some of that cash to shareholders through dividends or share buybacks, which can increase shareholder value.
Makes sense. And I guess having too much inventory falls into a similar category.
Absolutely. Every item sitting in a warehouse represents tied-up capital. You've got storage costs, insurance, not to mention the risk of obsolescence.
Especially in industries where things change quickly.
Exactly.
Yeah.
Technology, consumer preferences, all of that. Efficient companies try to minimize those costs while still making sure they have enough to meet demand.
So it's about finding that balance again, right? Not too much, not too little, but just the right amount of working capital to keep things running smoothly. But does this apply to every type of organization? Like, do smaller businesses or even nonprofits need to worry about these more sophisticated strategies?
Well, fundamental principles are universal, but the way they're applied definitely varies.
Yeah.
Think about a small business just starting out. Their main focus is probably going to be on managing cash flow effectively, maybe securing financing to fuel growth. They might not have the bandwidth to worry about optimizing inventory turnover to the same degree as a Fortune 500 company.
But they still need to make smart decisions with their resources.
Absolutely. Even for a small business, understanding when to pay suppliers, how to negotiate credit terms, and how to encourage customers to pay promptly can make a world of difference.
What about nonprofits? I imagine working capital management looks pretty different for them.
You're right. Nonprofits often operate with very limited resources and rely heavily on things like grants and donations, which can be unpredictable.
So managing their working capital effectively is crucial
Absolutely. They need to make those funds stretch as far as possible.
and ensure they have the cash flow to support their programs and services.
Exactly. They might use techniques like grant forecasting to anticipate future funding, or
Right.
maybe work on building strong relationships with donors who can provide bridge financing during those lean periods.
It sounds like a whole different set of challenges.
It is. But ultimately, whether it's a global corporation, a small business, or a nonprofit, the underlying principles of financial management are the same. It's about making strategic decisions, managing resources wisely, and ensuring the organization's financial health.
This deep dive has been so insightful. It's really amazing to see how these financial concepts, which can seem kind of abstract, actually touch every part of an organization.
They really do. From the day-to-day operations to that long-term vision, it's all connected. And the more you understand these concepts, the better equipped you'll be to navigate the business world, whether you're running a company, managing a department, or just trying to make informed decisions in your own life.
That's great advice. And to all our listeners, thank you so much for joining us on this deep dive into the world of financial management. We hope you found it valuable, and we encourage you to keep exploring this fascinating field. Until next time.